Hello, and welcome again to the channel. Today we discuss one of the strongest, but most surprisingly uncomplicated techniques in the whole world of investing, the buy and hold strategy. It has nothing to do with making money quickly. It has everything to do with making money for certain by creating wealth gradually over long periods of time. At its simplest, it's just about buying well-quality assets, whether it's stocks or mutual funds, and this is where the magic happens, holding on to them for years, even decades. It's all founded on a simple premise that, despite all the gloomy headlines and market drops we go through, the economy and the markets tend to go up in the long term. So let's look and see just how exactly this actually works. So what's the attitude in this case? The buy and hold philosophy really leans on three basic concepts. First, it's all about a long-term perspective. You're thinking about the overall growth of the economy in years and decades, not the day-to-day movements of stock prices. This does two excellent things. It provides you with maximum exposure to that long-term growth, and it completely cuts out those costly behavioral mistakes we all commit when we panic. Second, it needs quality asset selection. You're not investing in some crazy stock selection. You're investing in good, solid companies, broad index funds, real estate, and bonds, things that have proven to weather many economic cycles. And finally, it requires a belief in market efficiency, and that means you know that markets always recover from their slumps. It might take them a year, sometimes a couple of years, but history has shown us that they do recover, and that they reward those patient investors who wait it out. This is not my plan. It's endorsed by some of the greatest investing minds in history. It starts with Benjamin Graham, the creator of value investing. He showed us how to look for a margin of safety, to buy assets at a price below their intrinsic value. His Mr. Market concept, this flighty guy who offers you ridiculous prices every day, is an old lesson in not letting emotion dictate your decision. Then came along Jack Bogle, the founder of Vanguard. He applied this philosophy and gave us the perfect tool, the ultra-low-cost index fund. He basically began the entire passive investing movement, making it incredibly easy and inexpensive for the typical person to invest in the whole market. And all of that was famously validated by Warren Buffett. He's a direct protege of Graham, and he put his money where his mouth was. In 2005, he made a legendary $500,000 bet that a simple vanilla S&P 500 index fund would beat a highly selected basket of hedge funds over a decade. And guess what? He won. Handsomely. That should mean something to you. All right, this is where the magic comes in. We're talking about compound interest, and Albert Einstein reportedly called it the eighth wonder of the world. So what is it? Simple. It's earning interest on your interest. If you deposit $1,000 and it earns 10% or $100, now you've got $1,100. The following year, you earn 10% on that $1,100 or $110. So your funds build up not in a straight line, but on a ramping curve. The dividends you earned this year are doing work for you again next year. And the one ingredient to this trick is this: time. The longer your time horizon, the more spectacular and powerful is compounding growth. Now let's get that compounding engine in a higher gear with dividend reinvestment. This is how it works. Step 1. You're the owner of stock in a company or a fund, and they send you cash dividends. Step 2. Instead of doing that with that money and spending it, you just reinvest it through what's called a DRIP, a dividend reinvestment plan. And this will automatically invest that money in buying you more shares, and often, quite frequently, without commission fees. This leads to step 3, compound acceleration. You now have more shares, and then those shares receive more dividends the next time. And so you have this double layer of compounding, the share price increasing on its own, and your share number increasing forever. It's totally game-changing for your portfolio over the long run. Let's use some real numbers so you can see how spectacular this is. Let's say you start with $10,000. If you earn a modest 6% per year, in 10 years, you'll have almost $18,000. Not bad. But if you simply leave it there for 20 years, at a more market normal 7%, you're at almost $39,000. Now listen, If you can be patient and hold it for 30 years at an average return of 9%, that initial $10,000 swells to over $132,000. Did you catch that? Letting your time horizon stretch from 10 to 30 years doesn't only make you triple the money, it makes you over 7 times the money. That's the wild, non-linear magic of compounding in action. But does it really work in the real world? I hear you ask. Yes, and evidence is the S&P 500. It tracks 500 of America's biggest companies, and it's the ultimate case study for buy and hold. Since 1926, including reinvested dividends, the S&P 500 has boasted a compound annual growth rate of around 9.8%. Since 1957, its average annual return has been over 10.5%. And the kicker, about 70% of every year has been a positive one. Let that really sink in. Even through recessions, crashes, and pandemics, the market's been up 7 times out of 10. That's incredibly powerful upward bias. But you might be thinking, all right, but what about all those TV fund managers who are supposed to be geniuses? Can't they get it right? No, says the numbers, by landslide margins. This, as reported by the SPIVA scorecard, or official report card, of active managers versus their benchmarks. Over any given 1-year period, about 73% of active fund managers are unable to beat their benchmark index. Take a 5-year time horizon, and that failure rate jumps to a whopping 95.5%. And over 15 years, literally, there isn't a single category in which most active managers succeed. Let me be blunt. If 95% of well-off professionals with all their resources can't beat a plain vanilla index fund over 5 years, what do you or I have to think that we can do by investing in individual stocks? It's a statistically losing bet. So why does not everyone become rich if the plan is that straightforward and tried and tested? It's not an intelligent explanation, it's an emotional explanation. The market is driven by 2 powerful emotions, greed and fear. Greed kicks in when there's a bull market. Everybody's profiting, and we suffer from FOMO, fear of missing out, and we jump in and buy at the peak. Then after the market corrects, comes fear. We panic, sell our investment at a loss, and then sit on the sidelines, missing the all-important recovery that always follows afterwards. There is that famous case of the Fidelity Magellan Fund, which was so fantastically successful. But guess what? Individual investors in that fund lost money. How? They got in late, after it had already risen, and panicked out when it went down. The problem wasn't the fund, it was their own behavior. Which is why buy and hold is less an investment approach than an emotional system of discipline. It gives you a mental framework for ignoring all the noise in the market. It forces you to develop a robust volatility tolerance, to understand that the ups and downs of the market are a normal feature, not a flaw. By holding to a set plan and not being in and out of the market continuously, you entirely avoid the possibility of making those suicidal, emotionally based choices. You reap the reward of the mistakes of others instead of being a part of them. It's not hypothetical. Let me tell you about Grace Groner. She was a secretary who lived a modest life. She bought some shares of stock way back during the early years, and then she just held on to them. For decades, she reinvested every single dividend that came her way. That small initial investment, through the alchemy of holding and compounding, grew into a $7 million nest egg, which she bequeathed to a scholarship fund. She is not the only one. There are simply too many accounts of ordinary folk whose investments grew 20 or 30 times their initial value in 30-plus years, not because they were wise traders, but because they were staunch holders. They tied their investing to something higher than themselves, and that gave them the fortitude to hold on through the lows. Now, I don't want to make it sound like it's all peaches and cream. Buy and hold does have real risk, and it's primarily market fluctuation. We've experienced some ugly crashes. The Great Depression was a 79% loss, the dot-com bubble a 54% loss, and the 2008 financial crisis another precipitous drop. These are scary if you're experiencing them, but this is the key thing to remember. The market has rebounded from every single one of these declines. Every single one. Volatility isn't proof that the approach is invalid. It's the price of admission for making money over the long term. The self-control is to not get off the ride. Sometimes the rebound is a really long time coming. We call them lost decades. 2000 to 2009 is a good example. The S&P 500 actually registered a negative annual return for the whole decade. It didn't reach its pre-2000 level until May 2013, over 12 years later. And how do we protect ourselves against this? Two powerful weapons. Firstly, dollar cost averaging, simply putting in a fixed amount of money at regular time intervals, monthly, irrespective of what is going on in the market. In this way, you buy more units when they are cheap and fewer units when they cost more, thereby averaging your purchase price. Second, diversification. During that same decade of losses, a passive investor in the S&P 500 alone lost half their portfolio. But an investor with a diversified portfolio, including bonds and other positions, lost a lot less. Diversification is your seatbelt. It will not prevent you from crashing, but man, will it prevent you from going through the windshield. Here's a huge advantage of buy and hold that no one appears to realize. Taxes. You're only taxed on how long you've owned an asset. If you buy and sell within a year or shorter, that's a short-term gain, and you're taxed at your normal income tax rate, which is as much as 37%. Ouch. But if you hold it beyond a year, you qualify for long-term capital gains tax rates, which are much lower, 0% to 20%. Buy and hold just turns virtually all your profit into long-term. Even better, you don't have to pay any tax until you can sell. So your money gets to compound on the entire pre-tax amount for dozens of decades. A huge kick. And in some cases, if you hold until death, even the capital gains taxes can be avoided entirely for your heirs. Over time, your portfolio will drift away from your original plan as some investments grow at a higher rate than others. So every now and then, you have to rebalance. There are two main ways to do it. The first one is calendar-based rebalancing. You rebalance your portfolio every quarter or every year. It's convenient, but it triggers unnecessary trades and fees. The tolerance-based rebalancing is the superior method. You set a band, say 5%. If your 60% stock allocation has drifted to 65%, you offload stocks and put money in the underweighting asset to get back to 60%. It is a numbers-driven model that minimizes trading, costs, and those awful taxes we discussed. So what should you be buying and holding, you ask? You require a set of quality assets. Blue chip stocks, big, stalwart companies such as Apple or Amazon. Real estate in up-and-coming areas, which provides great diversification. Index funds are actually the secret to obtaining broad, ultra-low-cost diversification. And finally, bonds for stability. They act as a shock absorber when the stock market is volatile. The greatest way to implement buy and hold today is to couple Graham's intelligence in action with Bogle's genius, the passive index fund. While Graham's specific stock picking techniques do not work as well in our times, his psychological advice has never been more relevant. By investing in index funds, you get instant superior diversification across hundreds of companies without risking the failure of any one of them, and you get ultra-low expenses. With fees usually under 0.1% as opposed to 1 to 2% for active funds, that 1% you avoid paying every year goes directly into your compounding machine. In order to cling to this when the inevitable bear markets come, you will need a solid why. Why are you investing? Is it for financial freedom? For your kids' education? To leave something behind for others? Basing your money on a prosperous, personal reason transforms it. It's no longer about sterile numbers on a screen going up and down anymore. It's about creating meaningful momentum toward a life goal. That why gives you the mental anchor to see a market meltdown as an emergency sale on your future and not a disaster. All right, let's break this down into an easy, achievable plan. Here is your to-do list. First, prioritize dollar cost averaging. Automatically invest each month. It takes the emotion and the uncertainty out of attempting to time the market. Second, use passive indexing. Low-cost index funds ought to be at the center of your portfolio. It gives you the highest statistical chance of long-term success. Third, maximize reinvestment. Turn on automatic dividend reinvestment. DRIPs, on all your holdings. Make sure every penny is always working for you. Fourth, practice tax-aware maintenance. Hold your investments longer than a year to capture those lower tax rates and apply tolerance-based rebalancing to avoid triggering unnecessary taxes. And fifth, practice psychological strength. Accept volatility and correction will happen. Have faith in the time-proven precedent that patience is always rewarded. And thus we come to a beautiful paradox. In the investment game, doing less often allows you to get more done. The victory of the buy and hold strategy comes down to harnessing the unstoppable power of time and compounding, accepting the tried and true empirical reality that passive indexing prevails, and most importantly, mastering your own behavior. Your greatest enemy in building wealth isn't the market. It's your own emotional reaction to the market. By staying committed, by trusting the process, and by having the courage to do nothing when everyone else is panicking, you, as an ordinary investor, can achieve extraordinary wealth. It really is that simple. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.